Hello and welcome to Trading 5 Talents. In this week's video, this is my fourth week looking at the covered call suggestions put out by the weeklyoptionslist.com. There's a link down in the description to this service, as well as a link to this spreadsheet if you want to use it to track these types of trades. Otherwise, I also have a link to my full trade log that was made in Google Sheets with a dashboard tracking your cost basis, multiple types of trades, not just covered calls. If you want to try that out for free, then go ahead and click on the link below. All right, so this week, 418 covered call suggestions from the weekly options list using these filters right here. This is what happened. So you could see, let's just go to the summary really quickly. Out of 10 trades, 2 of them were assigned, 8 of them were not assigned, meaning you were able to keep your shares. So when you sell a covered call, you buy shares or at least own 100 shares, and then you sell one call against each lot of 100 shares that you own. So if you own 200 shares, you can sell 2 covered calls. So here we have this particular one. Let's just look at the NNOX. You would have purchased the shares on Monday morning at $11.40, and then you would have sold this call at $12.50. And by doing so, you gain 35 cents in credit or in premium. And then as the week progresses, you can see Monday, Tuesday, Wednesday, Thursday, Friday, it closes at $10.05, which is below your call strike price, meaning you kept all $35 of your premium, that is the call expired worthless, and you keep your shares. But notice, you bought your shares at $11.40, they closed at $10.05. So you're losing $135 on this trade in unrealized loss. Now, an unrealized loss just means that your portfolio value shows that this would be a negative $135. And unless you sell your shares at $10.05, that's not a real loss or a realized loss yet. So these shares could go back up next week. Hopefully they do if you entered this trade, and then you'll be able to sell more covered calls closer to your entry price or your break even, which would have been this $11.40. I don't think I need to go through every single one of these. I think you all know the routine. There's some things that I do want to mention though. Let's take a look at these 2 that were assigned. So first of all, Twitter. All right. Purchased at $45.51, it closed at $48.96, and you sold your covered call at $48.50. So how much would you have made on this play? So first of all, let's look if you just would have bought and held the shares until Friday and then sold them Friday at close. So our sell price would be $48.96 minus our $45.51. We would have made $345 on this trade if we just would have bought the shares, held on to them until Friday, and then sold them. Capital gains, $345. All right, now what about doing this covered call strategy? Well, first of all, we bought them at $45.51, but we had to sell them at $48.50. So $48.50, our sell price, minus $45.51, our buy price. So that is $2.99 or $299. So $299 as opposed to the $345 if we just would have bought and held the shares. But this is not the only money that you get or the only way of profit from selling covered calls. You get your capital appreciation if you sell a call above your entry price, like we did here, but you also get the premium. The premium here was $1.12. So we need to add $1.12 to this, and you can see our total profit then would be $4.11 per share or $411. So this here is obviously greater than $345. So we would have been better off selling a covered call using this play than if we just would have bought the shares, held them, and then sold the shares without selling any covered call. So this would have been a great play. So 411, let's just look at this. 411 divided by what we paid, $45.51. You can see the ROI then would have actually been 9%. 9%. It was calculated here at only 2.5%. Because it's just taking your credit that you received from the call, dividing it by the capital that you needed to purchase 100 shares. But really a 9% ROI in 1 week on Twitter, that would have been a very, very good and profitable trade. So if you took that trade, then congratulations. So the next one that was assigned was this RAD, purchase at $705 and then sell at $750, and it closed at $768. So how much would we have made either way? So 768 minus our purchase price of 705. Just buying and holding the shares, you would have made $63. Okay, $63. But instead what we did, we sold a covered call. Okay, so we gained 45 cents in capital or in stock appreciation, but we also need to add in our premium, and it looks like it's 63 cents. So in this case, both scenarios would have made exactly the same amount of money, whether you buy and hold the shares or you buy and sell a covered call, or this is called the buy right strategy. You buy and sell a covered call. So you gain the premium plus you gain the share appreciation. And in this case, it turned out to be exactly the same. All right, I have a note up here to mention something. And that note says, oh, look at SST. You opened at you purchased at $21.27, $103 in premium. That's a very high premium. $21.27 you purchase, and then you sell a covered call at $14.50. But notice what happened to SST. So Monday close at 21.11, then Tuesday right here, 13.42, 13.42, goes up to $14 Wednesday, just under $14 Thursday, just under $14 on Friday. $13.93 is the close. Obviously, the covered call expired worthless, so you kept all $103, but now you are down quite a bit. You opened at $21.27, and now it's at $13.93. Your unrealized loss right now is $734 on this trade. The note that I have up here is just a preference for me. When I sell options, whether it's a cash secured put or a covered call, I very rarely ever hold them until expiration. Usually I'm exiting anywhere from 50% to 90% of the maximum profit. Sometimes it's 75% to 90%. It all depends, but I'm exiting early. And there are a couple reasons for that. So one reason is to see if we can avoid these types of drops. So for example, if we looked at this SST right here, let me hide these things for a second. All right, so if we look at this SST, if we were to follow, let's say let's say a 50% rule, and we exit at 50% max profit, because we know this is a very volatile stock, and it can move wildly, as we see that it did during this week. If you would have purchased these shares at $21.27, sold the $24.50 covered call, and gained $1.03 in premium, if we had our 50% rule in place, we would have exited by Monday. So this, this would have been a day trade, maybe 2 day trades, but this is what would have happened. We would have, let's say, just exit Monday, right before close. We would have gained our $38, and our $38 divided by our total profit, our total credit, that represents 63% of our max profit, 63% of our max profit gained, because, let me just show you. So 103 minus the 38, we would have gained $65 already by Monday at close. So for Monday open down to Monday close, there was just a huge drop in volatility. We would have gained $65 right off the bat. So we could have closed that early, because that would have been over our 50% threshold. We could have got rid of our shares, at 21.11. And yeah, we would have lost a little bit of money on the shares, but not like this. So, I don't know I would have done that. I'm not sure I would have known that it was going to crash like that. But obviously this is a very volatile stock. SST was quite an adventure for me a week or so ago. I did make a lot of money, and I knew that it's very volatile. So all I want to do is I just want to caution you, when you sell options, really consider exiting prior to expiration. That way you don't get caught in a large move up or down, depending on whether or not you want it to go up or down. But also it frees up your money or your collateral, so you can put on another trade for the next week to take off the weekend theta decay. So there are a couple advantages to exiting early. I would just set a threshold of when you want to exit. For me, it's anywhere from 50 to 90% of the max profit that I'll exit at. And again, frees up capital, protects me from some down moves. And quite honestly, there have been a lot of down moves lately in the market. So I'm not saying that I'm immune to them, because I definitely get caught in a lot of bad moves, and I get caught bag holding. So I have a video that I'll link to up at the top in the cards of some things that you can do if you are caught bag holding. Like if you're caught holding SST, what can you do here? there's a few things that you can do. It's going to take some time. Anytime you're bag holding, it's going to take some time to climb out of that. But there are definitely some moves that you can make to try to get to your break even much faster. One more week of looking at the covered call list from weeklyoptionslist.com. And then I'll give my final verdict on whether or not I believe this list is also worth it, just as the put list was worth it. So in the meantime, if you have any questions, leave a comment down below. Catch me on Twitter at Trading5Talents. And to stay up to date, click on subscribe, turn on the notifications so you can catch all the updates. Until next time, trade wisely. Take care.